The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Consumers take a breather, and so too does the equity rally. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Isabel Lee. Romaine, it's finally Friday, and this is where we stand. We got a data dump today. Can I say data dump? I guess I just said it, but it showed that the engine of the U.S. economy is cooling from consumer sales to retail sales. You're seeing the S&P down by nearly 0.2%. The Nasdaq edging also lower by 0.3%. The two-year yield, actually, extending its declines for the third straight week as Fed rate cuts crumble. And lastly, we're seeing Brent crude oil higher by nearly 2% as the geopolitical tensions, Romaine, continue to rise.
As for the S&P 500, a modest day of losses, capping what is still going to be a modest week of gains. Though the weakness to end the week tied directly to that 1-2 punch of the worst U.S. retail sales report in more than a year, and a UMich gauge on consumer sentiment showing deteriorating perceptions of both the short and the long-term economic outlook. Those renewed concerns about the consumer coming at a time of renewed concerns about the AI trade. The Philadelphia Semiconductor Index, which came into 2026 with 10 straight weeks of gains, it actually hasn't posted back-to-back weekly gains since mid-June, nor back-to-back weekly losses. A now 7-week seesaw between gains one week and losses the next, a testament maybe to that division in attitudes about how much room the AI trade has left, particularly with only one remaining major tech earnings report on the calendar, and that's NVIDIA, in about a week and a half. And it will be an interesting cap to the earnings season, which on the surface is phenomenal. But these massive earnings beats and the guidance that we saw from tech and non-tech companies alike, they're actually barely moving the stock price needle. Since earnings began in early July, the NASDAQ 100 is flat, the SOX is in the red, and the S&P's 3% gain, well, that's barely a third of the surge we saw during the Q1 season. That divergence is now driving one of the sharpest declines in the S&P's forward price to earnings multiple on record.
What everybody wants to talk about is this peak earnings. And if you think about whether the market's positioned for that or whether it's priced in, I won't go into the multiples. What I would say is equity positioning is aligned with 14-15% growth right now, which is not bad growth, but we are getting 35% and likely to get 25%. So positioning, there's still upside for the market.
And that was Bokeh Chada speaking earlier, Isabel. We talk about that 35% growth. It kind of makes you wonder, are people still optimistic for the next couple of quarters ahead?
I think people are, because, Romaine, the revisions have been really stellar. I mean, I know that we have NVIDIA next week, but if you think about it, we're almost done with the earnings cycle. And one interesting signal as we wrap up the weekend this season is earnings revisions. So they're actually gaining momentum. So as you can see here, the green line and the little tick up there, you see it kind of, it's gaining there. And we've seen the highest upward number of revisions for the quarter so far. We have 59 companies raising their outlook earlier this month. So despite some softer economic data, corporate earnings expectations really, Romaine, are moving higher.
All right. Well, our next guest actually says that other than in recession eras here, that what the momentum that we've seen in earnings is basically a cycle unlike any other. Jurrien joins us right now to kick us off to the close, Director of Global Macro for Fidelity. And Jurrien, that is kind of where I want to start. We talk about the earnings growth clip that we've seen. Revenue growth, too, we should point out, has been also phenomenal. I mean, we know by default these rates can't continue, but I guess the question right now is this going to be sort of a moderation of some of those growth rates, or is this going to be one of those areas where we just fall off a cliff one quarter?
Yeah, so it is the big question, of course. So we are in an earnings bonanza, if you will. Earnings season is just about wrapping up. The growth rate in year-over-year earnings for the second quarter started the quarter at about 25% or so. It's now at 32%. And the momentum is just incredibly strong. If you think about this, right, the dollar estimate or the dollar earnings number for the S&P, which is in the low 300s, is up $100 year over year, and the growth rate is 35%. So both the level and the growth rate are still accelerating. So the momentum is there. The estimates for the coming quarters are equally still revising. And what we have always found is that there's a lot of alpha, if you will, in finding stocks where there's positive earnings momentum and earnings revision. So at some point, the growth rate is undoubtedly going to slow, as it always does, right? It's a stochastic indicator. And at that point, I think as Warren Buffett always said, when the tide goes out, you'll see who's swimming naked. But at this point, the forward PE on the S&P cap-weighted index is 20. On the equal-weighted index, it's 18. 75% of the S&P 500 is in uptrends above their 200-day moving average. There is some risk from rising interest rates, and the 10-year is at 4.70.
Right.
And of course, we can talk about risks in AI and how that's all being financed and all of that. But for now, this is a very strong earnings-driven momentum market.
Well, let's talk about the risk in AI, because, one kind of interesting thing with this record high that we set the other day on the S&P, and we should point out the equal weight index today actually could close at another record high. That seems to suggest not just breadth, but also the idea that some folks have turned away from the AI trade, or at least the big names they sort of got us here over the last 3 years. What are you seeing?
So I'm very comforted, let's put it that way, by the fact that now twice this year, earlier during the Iran conflict and now more recently when the S&P peaked at June 2nd and essentially went sideways while the Mag 7 and the AI space went down some 15%, the market survived it pretty well. The market broadened, as the AI trade goes down, the non-AI trade goes up. Breadth has broadened. Global markets are participating. So there are a lot of fish in the sea right now, and we're fishing from a big pond, which is a very big improvement from where we were really over the last 10 years, where if you were not in those mega caps, you were just not participating, and now you can participate. And so the fact that these rotations, they don't happen in an up market, but at least they don't happen in a strongly down market, I think is a very healthy sign.
So the S&P is around 20 times forward earnings. When you look in the pond, is it cheap enough to keep buying, or do you think we're back to the so-called price to perfection territory?
So it depends on how you look at it, right? Valuation is one of those funny things where, beauty is in the eye of the beholder, and you can have bears and bulls arguing over the exact same numbers and come up with different conclusions. So the forward multiples are very reasonable. Even the trailing 12-month numbers are, in the low to mid 20s, so that's not terrible. The CAPE numbers, right, the cyclically adjusted PE, like the 5-year, is near all-time highs at around 34. So a bear probably would point to that. But if you think about it, the way earnings have grown over the last 5 years, from the COVID days till now this AI boom, a CAPE ratio is gonna make the market probably look more expensive than it is, just because it's weighted down by those weaker earnings. But I would say, again, when the earnings momentum starts to fall off, and as Romain asked, I don't think it's going to be a cliff, but it could be a slowdown, then at that point, we have to look at how expensive is the market or not expensive, and how crowded is the trade. We've seen the ETF flows into single-name levered ETFs in the semiconductor space. By my count, between the US and Korea, about $70 billion has been chasing that space. So there are pockets of crowded trade, but overall, from what we are seeing, the demand for chips is still well ahead of the supply. And we can talk about, the financing. There's about $500 billion coming in investment-grade bond issuance this year, another $500 billion next year. How is that going to be financed? Does that crowd out the treasuries market? How does that juxtapose against the depreciation of the chips? Those are, I think, the big questions, but the actual fundamentals right now are white hot.
We do love looking at leverage ETFs. In the past month, I think they sucked in around $3.7 billion, which is just impressive. I think the wild card here is bond yields. At what level does the rise in the term premium become a serious threat to equities, in your view?
So to me, that has been one of the two main tail risks, I guess you could call it. One is the concentration risk in the S&P of the top 10 names being 40%, and it's all AI all the time. Again, I'm heartened by the fact that the market has been able to rotate without a lot of damage. And then the other side is the bond market. The 10-year yield is at 4.7, so that's a PE, if you were to flip that upside down, of around 22, 21. That's where the S&P's PE is as well. And so when the safe asset is yielding competitively against the risky asset, and the safe asset goes up in yield or down in valuation, the stock market needs to adjust to that by also lowering its PE. And then it becomes a question of to what degree that is offset by earnings, right? Price is always just the residual of earnings and valuation. And so if the PE goes down from 20, let's say, to 16 because bond yields are going to 5 and above, and that's not a prediction, but it could happen, then it depends, right? If earnings are flat, the market's going to go down 15, 20%. But if earnings are growing 30%, that's going to be an offset. So that's kind of how the waves kind of go back and forth. But I do see more upside risk to Treasury yields than downside risk. The economy is running pretty hot, even though we had a weak retail sales number and the payroll number was soft, although I think that's mostly a statistical thing. But overall, I think there's more upside, and the stock market needs to pay attention to that.
Just quickly, we only have about a minute left, Jurrien, but I am curious as to how you map in energy prices right now, given the not so much just the volatility in prices, but really the volatility in, let's just say, the policy and approach to the war in Iran, and whether we actually get the Strait of Hormuz open anytime soon.
Yeah, this has been a puzzling question, I think, for many of us, because this really has been the dog that hasn't barked, or it's barked but hasn't bitten yet. So we keep looking at these numbers, the inventory numbers, the Strait of Hormuz, and how ships can or can't go through. And yet oil prices do remain fairly orderly, and they haven't really scared the market. I think that could change any moment. China may very well become the key player here because it actually has the ability to export oil, which not many others do. But it's been puzzling that it has not had a more negative effect. I'll be candid on that front.
Jurrien, always a pleasure, always smart. Jurrien Timmer, Director of Global Macro for Fidelity, kicking us off to the close here on this Friday afternoon. A closer look at the economy and a closer look at the fight against inflation, or maybe a decision to help out the consumer. We're going to catch up with former Boston Fed President Eric Rosengren to talk about the potential paths ahead for the Fed.
And from economic drivers to driver's seat, Aston Martin CEO Adrian Hallmark joins us to unveil his company's latest model and discuss the road ahead for luxury automakers. And we continue our coverage of the business of sports here on The Close, and we're going to talk about streaming. If you've tried to stream the NFL, MLB, NBA, you're paying a lot, and believe it or not, it's raising some antitrust concerns. We're going to catch up with Kellie, Lerner, a managing partner at the antitrust law firm Shinder, Cantor, Lerner. That's coming up in just a second, right here on The Close, right here on Bloomberg. All right, let's check in on the markets as we head towards the end of the week. The stocks are down on the day, though. Isabel, the S&P looks like, barring some major change in the next 45 minutes, still going to end up on a weekly basis here. But it's kind of interesting, when we talk about this mix, and we talk a lot this week about yield, the yield picture, and obviously what's been going on with Brent crude, as well as in currencies, and sort of all of the currents that seem to be batting that around. There is a lot of cross currents. I want to point out it's going to be the third straight week. We are on track for that. That's the longest stretch since May. So that's good news in equity land. But you're right. The cross currents underneath is still kind of murky, especially with the data dump today. I'm saying it again. Yeah, but we talk about that data. I mean, we had the two inflation reports this week, which were benign. You had a retail sales report this morning that, I think some people are dismissing as maybe a little bit of an anomaly, though it was bad. Yes. Down 0.6%. But the idea here is that maybe that corrects itself. But then you have a PCE report coming up later, and then we're kind of almost through earnings. So this is kind of the picture for the Fed when they go into that mid-September meeting. Yes, and I don't know if what they see is a nice picture. We have Brent Canwell of eToro. He's saying that investors should be careful what they wish for because we keep on wishing that we don't want to hike. But then if we're getting economic weakness as an exchange, that might not be that good. Of course, the other big story out this week has been the tech trade. I was taking a look at some of the individual movers on the day, but also on the week.
surprise, SanDisk at the top of the leaderboard. It's up 34% this week,
Wow.
believe it or not. A lot of those gains came yesterday, but Supermicro, Seagate, those are your three biggest movers this week in the S&P 500. And then I was taking a look at retail too. And that's a mixed picture. Wayfair up, but then you have names like Tapestry, Ulta Beauty, and a few others that are down pretty hard on a weekly basis.
I saw Reddit there. It's higher by 11%.
Yeah, and I know we're going to talk about that a little bit later, and you have to explain that to me because I still don't think I understand. I mean, it's fun to go to. I don't know exactly what the business model is for that. And then take a look at this. These are a lot of the drone makers here. You have Kratos, Aero Environment, Unusual Machines is not on the board, but that's up in double-digit percentages, and that seems to be tied to this move by the Trump administration to put tariffs on Chinese drones and drone components.
There is that, and I want to just quickly go back to the Wayfair comment, because the K-shaped economy, it depends on who you ask. Some people say it's narrowing, but some people say it's widening. I feel like it's widening because every time I go to the grocery or buy little things, it's becoming harder and harder.
Well, anybody who goes out there, I mean, I know we talk about this at an academic level, but as you said, anybody who goes out and shops, you see the price pressures out there. Now, whether you can afford it or not, that's another question. And we're going to talk about that in the 4 p.m. hour today, this idea of all these earnings that we're going to get next week out of some of these retailers like your Walmarts and Targets and Home Depots, Estee Lauders, and a few other TJX I'm forgetting. So maybe they'll give us a better picture of, what that K-shaped economy looks like and kind of where exactly maybe those companies might either benefit or maybe be hurt by it.
And yesterday we talked about Tapestry, and Coach is still seeing a lot of gains. So, I mean, people are still shopping. They're just more selective. So lots to talk about, definitely. So coming up, we're looking at Workday. You see the shares there up in the green, nearly 14%. That's after a report of a takeover bid from Silver Lake. We'll break that down and all the moves next. This is The Close on Bloomberg.
All right, we're keeping an eye on shares of Workday. They are down on the day, but after yesterday's 18% gain, they're still headed for their best weekly gain in about a year. Yesterday was the best day for that stock since 2016, and it all boils down to some reporting out there. It started with Reuters saying that Silver Lake is in talks to buy the software company. A software company? Yeah. Our next guest actually says that it kind of actually makes sense. If you will, it makes the most sense in the application software space to acquire. And he actually believes that a fair buyout price for Workday shares could actually fall somewhere in the 240 to 250 range. Of course, those shares right now trading right around 198. Scott Berg joins us right now, senior analyst over at Needham, to talk a little bit more about this. And of course, I think when we saw this report the other day, the first question was, I thought everyone fell out of love with software. But I was looking at your note, and your thesis kind of makes a good point. I mean, you kind of can't look at all software companies the same. And Workday, of course, does something very specific that you seem to think is going to be a little bit more resilient in this AI era. Explain.
Yeah, I think when you look at software broadly speaking in application software spaces, there is clearly some applications that companies could either custom code themselves with some of the newer generative vibe coding methods or other ways to bring in some of those technologies and save costs. But the regulatory risk and the compliance risk and just the internal complexities around workflows make software like payroll and core ERP and financials very unlikely to be thrown into that custom or vibe coded bucket anytime soon. There's just a lot of business risk with that. And under that backdrop, this is a very good large business that should have durable growth in those categories because customers don't want to take that risk. And if that's the case with where valuations have been in my sector over the last 6 months, Workday probably makes as good a sense as any company to potentially take a swing at.
Well, talk to me about the potential valuation. You said a fair acquisition price would be about 240 to 250. Obviously, a share price that we haven't seen since at least last fall, I believe. And I think the all-time high was around 307 back in 2024. I mean, that's still a long way. That's a big gap between where we are today and what you think fair value might be.
It certainly is. We've never seen an acquisition of an enterprise software company of this size and scale before. This would be the largest one that I'm certainly aware of. But if we look back at other transactions over the last 18 months, there's two other payroll software providers, Dayforce and Paycor, that were both acquired at premiums that were about 22, 23% higher than Workday's price was yesterday at the close. And so if we use that as a comparable backdrop, both were taken out just above 5 times revenue. That would put a Workday share price in that 240 to 250 range, as I mentioned in my note today. But that's probably the closest barometer for us to look at in recent years, at least.
How much of Workday's growth is actually at risk from AI competitors like OpenAI or Anthropic, or do you think that those fears are overblown?
Yeah, I've actually taken more of a contrarian view, I think, on this viewpoint over the last year or two. I think the fears around payroll and ERP financials are overblown. I have a couple taglines that I've said for a long time in this space, like around payroll. It's amazing how quickly your employees leave if you don't pay them accurately. If you're going to try to vibe code payroll, that has to be accurate. But against the backdrop and complexity around payroll and tax laws that are significantly different from state to state. Same thing with ERP core financials. If your books are not accurate or right, people go to jail, for those discrepancies. So, these are software that is not on the fringe on the edges of what companies can actually use and feel comfort with at the end of the day. So they actually need something that's more hard and ready to go and doesn't have errors.
What about the CEO? He's back. Do you think that he's the right person to lead Workday to becoming an AI company, or do you think that Workday maybe perhaps needs a bigger strategic reset?
I think the world of Anil, personally, from a product person, and given what the industry is going through on the product side, I really do think he is the right fit. He has been the product engine at the company for, his entire first stint there, which was 16, 17 years. And his return, I think, is very much well warranted. If it's not him on a go-forward basis, someone very much like him, I think should be at the reins of this company. But he's a perfect fit for what they're trying to go through today.
Only about a minute left, Scott, but I am curious about if this deal does come to fruition, sort of what the financing looks like, particularly coming out of the private equity space at a time where it seems that there still is a lot of skittishness around this, despite your a bit more optimism there. Do you think that they would actually be able to finance this at a cost of capital that wouldn't hamstring Workday too much going forward?
Yeah, I do think that's the biggest risk of this transaction getting done today. If we look at software takeouts over the last 15 plus years, private credit has been heavily involved with lots of these. They have been leveraged buyouts for the most part. And if we look at what the private credit backdrop today looks like, there's a lot of concern about these companies and their not necessarily overly heavy exposure to software, but certainly heavier exposure to software and what the terminal risk of some of these businesses are. So as the debt of existing companies comes up over the next couple of years, will they get to be refinanced? Well, you have the same question with a takeout like Workday is, can a private equity sponsor, whether it's Silver Lake or a consortium of private equity funds, can they raise what's ultimately probably $20 to maybe $24 billion worth of debt required to get this leverage buyout done? Yeah. I'm not saying they can't, but that's, I think, probably the biggest concern that the market would have to actually getting this transaction done today.
All right, Scott, great stuff. Got to get you back. Scott Berg, senior analyst over at Needham. Workday shares, which are down more than 30% from its last all-time high a couple years ago, getting a nice bump on the week, up about 10%. Coming up here, we're going to recap this week's economic data and particularly what we learned from the retail sales report. Does it move the needle for the Fed? That conversation's up next.
And I think what we're also seeing is that the consumers are being much more careful about what they're buying themselves. It used to be in the past that when you'd go out shopping, like you do during the holidays, that you would shop a little bit for your family and shop for yourself as much. Not as much in this particular survey. We heard most consumers say they're going to get the basic needs, the basic necessities for their families and their kids, and they may not buy themselves the stuff that they're used to buying, that aspirational shopping that we're so used to seeing in the past.
Naveen Jaggi, who runs JLL's retail advisory business, he joined us yesterday here on The Close, Isabel, and we were talking a lot about the state of the consumer, whether they are actually shopping. We got a retail sales report that seemed to suggest, at least for certain items, they're not.
I know, Romaine. Yeah. So 5 of the 13 categories in the report posted declines. What shocked me the most is non-store retailers such as Amazon also seeing the biggest drop. Because if someone is not shopping in Amazon, that means that the economy is bad. I buy the silliest things at Amazon, Romaine. Do you want to know an example?
What's that?
Like toothpaste. toothbrush.
Yeah.
You don't look like the type to do that because
Yeah.
you're a deliberate person.
I got a guy in Baltimore that I love, custom made, Isabel.
Fancy.
But it does get to the idea here of whether we sort of take this as a one-off, whether it actually really does paint a more accurate picture of the U.S. economy, and more importantly, whether the Fed should actually even pay attention to it. Remember, inflation, that was also an issue. We got a couple of those reports earlier this week. Let's bring in Eric Rosengren. He's the former president of the Boston Federal Reserve. And Eric, I do want to start with the state of the consumer, and we'll get to inflation in a second. But I was looking at that retail sales number today, that contraction overall. Gas and autos obviously dragged down a lot of it. Online sales too. But then I looked at restaurants, that was up. So we're still spending somewhere. And there were a lot of other categories that seem to suggest the consumer is still spending. What does a debate look like amongst Fed members when you kind of have data, even in one report, and even the trend line that seems to kind of, let's just say, conflict with each other?
So the Fed doesn't focus just on one number. It does tend to focus on a trend. But I think a weaker retail sales number is consistent with what we've been seeing in consumption for the first half of the year. So if you look at consumption over the first 2 quarters, it only grew at 1.5%. So that's weaker than the overall economy. It's a lot weaker than what's been happening in investment. So we have an economy where kind of AI and tech investment are driving investment spending, but the consumer has been buffeted by higher oil prices, maybe some concerns about what's going on in the Middle East. And as a result, they've been somewhat more reluctant to buy, particularly for those low-income individuals who are likely to be more strapped by the oil prices going up. So I think the picture that this retail sales provides is pretty consistent with consumption that's not really driving the economy. Right now, what's really driving the economy is investment spending.
Well, I'm curious, does that worry you at all, or is this just sort of the natural cycles that the economy goes through from time to time?
Well, if the consumer was a little bit, I mean, consumption is an important component of GDP. It's roughly 2/3 of spending is 2/3 of all GDP. So anytime consumption slows down, economists tend to pay attention. But I think what we have is a somewhat different balance than we normally see, particularly in an environment where the stock market has been going up so strongly. So the economy is growing probably at the appropriate rate overall, maybe a little bit weaker than we'd like. And a lot of that is because the consumer has continued to be somewhat lethargic.
What about inflation? It's now at around 3.4%. I mean, that's well above the Fed's 2% target. How do you make the case of why the Fed should cut rates with inflation this sticky?
So I think the debate is really going to be about whether the Fed should raise rates or leave them the same. As you point out, the CPI number that came out in the beginning of this week at 3.4% is well above the Fed's target. I think those that are willing to wait are arguing that when you take out food and energy, shelter has not been going up nearly as rapidly, and it's not widespread increases. So they think as oil prices come down, we'll see the overall inflation rate come down. I think the other side of the argument is that the Fed has been hoping that inflation would come down more naturally by waiting for 5 years now, and it hasn't happened. And so I think there's a subset of the committee that is concerned that we keep expecting inflation to come down, but when we get through a couple quarters, we find that once again the Fed has missed its target by a significant amount. So I think for those that are concerned that inflation has been quite high, they're probably still going to have that concern. And for those who want to wait, I think they're still going to argue that it's being driven primarily by oil prices, and that when oil prices come down, that there'll be less concern about inflation.
And you made the point that the Fed usually takes a look at the data in their totality, but on one hand you have higher inflation and on the other you have a weakening consumer. Which do you think, if you were just to pick between the two, is scaring the Fed more?
Well, I think right now they're pretty focused on inflation. So if you look at the press conference that the chair provided after the FOMC, he emphasized that the committee was quite focused on getting an inflation rate back to 2%. So they're never going to be happy when we get weak real economic data in. But I think right now they're going to be primarily focused on what are the expectations for how long it takes inflation to come down to the 2% inflation target.
I want to get your thoughts, though, also on this idea of how the market reacts to this, and particularly with some of the moves that we've seen in the bond market, particularly on the longer end of the curve, with that 30-year yield going up. Obviously a reflection of longer-term concerns, certainly about inflation, fiscal deficits, and the like here. Does that, I mean, not to be glib about it, but does that kind of do some of the work for the Fed if the bond market continues to reprice down, the price down, yields up on the longer end?
So it does slow down the economy if we have higher rates, and that's whether it's initiated by the Fed or other conditions. But if the reason the long rate is up is because they're not confident that the Fed will bring inflation down, that's a problem for the Fed. That's really not the way they want the market to tighten, because they have less confidence in the Fed doing what they're saying they are supposed to do. I think that the deficit obviously is an issue. And as we've seen in Japan, there's been concern about interest rate differentials between the Japanese and the United States. And they're worried that they're going to be selling Treasury securities in order to be able to defend their currency. So I think there are a variety of factors going on for why the long end is up. But I don't think it's a little bit glib to just say that the market is doing the Fed's work for it. I think you have to interpret why it's moving. And I think the reasons why it's probably moved up, it started moving up at the press conference. That was an indication that they weren't as confident that the actions of the Fed were going to be commensurate with how they've described what they're planning on doing on inflation.
Based on what we learned out of the last meeting with Fed Chair Warsh, the idea is that communication, at least from him, is likely to be a little bit less than maybe what we got out of his predecessors. Does that complicate things for the market and, for that matter, in turn, back on Kevin Warsh?
Well, there are other Fed presidents and governors who are speaking, and I think there were people speaking on both sides of the last decision. I think the challenge is that there's only one person who can speak for the entire committee, and that's Chair Warsh. And if he doesn't speak for the whole committee, then you have a bunch of people speaking from their own viewpoint. And I think it would actually be good. You don't have to provide forward guidance, but I think it is important to provide a little bit of context for why decisions are being made. And since, especially coming out of an FOMC meeting, I think it's important for the chair to basically say the reason the committee made the decision they did is the following. And that doesn't have to be forward-looking. It doesn't have to say anything about what they're going to do in the future. Mm-hmm. But I do think it is important to justify what the majority of the committee decided at each meeting.
All right, Eric, always appreciate it. Eric Rosengren, former Boston Fed president there. And we should point out for our viewers, we did hear from a couple Fed presidents this week, including from Alston Goolsbee, speaking in a Bloomberg interview yesterday, saying that he is encouraged by the recent cooling in inflation, but any continued drop in retail sales over the multiple months would actually make him nervous. All right, we turn back to the broader markets. Marginal losses on the day, but an interesting standout on a single stock basis. It's Reddit. Shares surging because the S&P has decided it should be included in the S&P 500. We're going to have that conversation as part of our Stock of the Hour next. This is Bloomberg.
Today's Stock of the Hour is Reddit. Shares jumping as it's set to join the S&P 500 prior to the start of trading on August 18. So the social networking name will replace Avalon Bay Communities in the S&P 500, which is being acquired by Equity Residential. So, Romain, this is a big deal. So every time the S&P announces something, it's around 5:16 p.m. And yesterday I was making my escape. And I was already in the escalator. Right. And bam, they were in my inbox and I had to go back to my seat. Yeah, it raises a lot of questions. And I have a lot of questions. Ask away. You cover the stock. So, I mean, I don't want to be glib about it. This is a stock that has had a huge run-up since it went public a couple of years ago. It's posted very healthy revenue growth, like 60+% for like the last 8 quarters or so. The EBITDA is there. Even on a GAAP basis, it's there. But
But is this a stock that should be in the S&P 500?
It's a good question, but
Yeah.
if you think about it, there are something like 500 companies there. Maybe it's not the best company, but since it's IPO, it's had great earnings. And it's leaning into AI. I mean, who else? And Reddit is Reddit. I mean,
Yeah.
it's a cultural phenomenon. Do you use Reddit?
I do. I have a
Oh,
secret,
really?
Oh, yeah, I have a secret handle that I just go and troll
Oh, you'll
everybody.
whisper it to me later, maybe.
No, I just go there and troll everybody on Wall Street bets.
I use Reddit a lot. I mean, 90% of their
Bet it all, single day options.
90% of their revenue is still in advertising, but they're having other streams
That's what I'm curious about, because when I think of this, I think, okay, is it just a pure advertising play, or is there sort of a broader business model here beyond just just trying to post ads?
No, they're looking to make money with the AI boom. I mean, if you're the big guys, AI, OpenAI or Anthropic, I mean, Reddit has a stream and a mine of information and data. So it's
haven't they
amazing.
accused like some of these LLMs of basically stealing or at least scraping their all the stuff off there without permission? I think I saw some stat, I don't know if it's true, where they were saying that something like a huge percentage of the responses that you get from some of these LLMs are basically just scraped from Reddit.
I think I've heard that also.
Yeah.
But I do love Reddit. I'm looking for a new electric kettle.
Kettle, yeah.
And the options are varied. It's either $40 or $200. You probably have the $200 one, but yes, I am in Reddit looking for one.
No, I'm like, I don't believe in electric. I believe in the pot on the stove.
Oh, like my grandmother. Sorry.
Thank you, Isabel. On that note, the shares of Reddit having a good day here, up more than 12% here. In fact, it's one of the few standouts here on an otherwise quiet day. We should point out it is a quiet day. Volume right now at this time in the S&P 500 down more than 25%, as I think a lot of people didn't show up to work. I don't know if you were walking around upstairs here, but I think
it was ghost town.
I think we're the only two people in the building. Kim Forrest is going to be joining us, probably by Zoom, but we thank her for her service. Founder, CIO of Bokeh Capital Partners, coming up next after the break, right here on Bloomberg. Just about 10 minutes away until we get to the closing bells. I'm Romaine Boston.
And I'm Isabel Lee. So, Romaine, you're seeing, I like our next guest. She said that it's a weird Friday here, and I think it is indeed a weird Friday. I mean, you've pointed out it's kind of ghost town, but also markets are weird. We saw a huge data dump today. I should stop saying that, actually. It's the fourth time I said it in the show. But anyway, the data is conflicting.
Yeah, it is conflicting, and it kind of creates, I don't know, maybe a conundrum for the Fed, but I think ultimately what it kind of means is maybe they just don't do anything. And that might actually be good enough for the markets. I mean, they've digested all of these earnings, and so far, so good. But I guess the big question is kind of what is that sort of next sort of big bump for this rally, given how high some of the valuations are. As we get closer to the closing bells there, and you can see with the S&P down about, and the NASDAQ 100 down about 0.2%. A few headlines are crossing the wire on a couple of individual names, one involving PayPal, and this had been reported by Reuters a little while ago. Now the Wall Street Journal jumping on the story, talking about that Stripe Advent could potentially be coming together in the coming weeks to make a bid for PayPal. Those shares now up about 2%. We should say that PayPal had seen the previous offer that had been reported by Reuters a while back of $60.50 a share as insufficient. Those shares now trading at right around $62 a share. And just real quickly, keep an eye on Paramount Skydance as well. They're out making some comments right now about some of the regulatory issues surrounding their effort to close that deal on Warner Brothers Discovery. Paramount urging the 12 state attorney generals that have been contesting this to, quote, engage in good faith.
And also, I mean, to your point earlier, we're seeing retailers next week, and it will really say a lot about the mood of the economy. I mean, I have stopped spending a little bit, Romaine.
All right, let's get right to Kim Forrest, founder and CIO over at Bokeh Capital Partners. And Kim, I do want to start with the tech trade for a second, because to a certain extent, it kind of got a little bit of a second life here. I mean, we saw that SanDisk Investor Day here in New York, where they gave a long-term forecast through 2023 that seemed to suggest that, okay, at least in their view, they think that the supply chain constraints and other things that have benefited them are going to continue to benefit them. Although we heard from Cisco and a few other companies that, well, maybe things aren't all that rosy. What do you kind of make of what we've learned so far out of the earnings season from some of these tech names?
Sure. Well, I think going in, everything was priced to perfection, that, AI was going to take over the world. Software was a thing of the past because we could just speak to our computer and say, write me a new HR system or whatever people thought, right? And some of those ideas have come crashing down, and with it, prices. But I think today's news was really interesting. If you have followed memory, and by this I'm thinking about the non-volatile data containing a memory that's called NAND, it's been always on a roller coaster because it's very expensive, just like any semiconductor, to make a new fabrication plant or to expand capacity. So what they do is, put a whole bunch of money, expand capacity dramatically. There were only a handful of providers. So you went on this roller coaster ride of oversupply, overdemand, oversupply. And now we've had a persistent undersupply, and it looks like SanDisk is using contracts to try to work their way around this. And while I don't think it's a complete fix, it's on the road to being fixed with these contracts. Yeah. So I think that is a really great thing that's coming out of this, right? We're not just going to be whipsawed as investors anymore.
I wanted to separate, though, also this idea of AI being this kind of big structural thing for our society, whether we want it to be or not, with the idea of how it's actually being funded. And there was a lot of talk made about Jensen Huang's sort of effort to create this kind of $500 billion financing pool. I'm sure you've heard the jokes that basically NVIDIA is like the central bank now for the AI trade. And I just, I mean, who knows? I mean, maybe this all works out, but we have to ask the skeptical questions. And I am curious if you are concerned at all about how much this flywheel all links back effectively to one company.
Yeah, it is concerning, although I have to say I felt really good earlier this year that we've had some other winners other than NVIDIA. NVIDIA was AI, to paraphrase somebody else. Mm-hmm. But I think that is really concerning. And then they're able, because they're still very influential, but not the only answer in town. And certainly as AI plays out, and this is, I think, my special sauce is I have a different vision. I don't think LLMs take over the world. I think LLMs are going to be maybe the delivery mechanism, but there's going to be other models in the back that have nothing to do with large language models. You ask a large language model to get you an answer, and other models take over. It uses other models. I know this is kind of crazy, but that is going to use different kinds of compute. So are we building too much? Maybe, but maybe it's going to be turned into what I think are those smaller targeted models that are going to answer specific questions. And I don't think that most investors have the same idea or model of the models that I do.
Kim, I want to zoom out a little bit because we're seeing strong AI demand alongside a softer consumer. Do you think that AI can keep on carrying the market? We do get a lot of retail reports next week.
I think retail is going to come into the spotlight, and for good reason. I don't know that many actual consumers are spending for AI, so that kind of gets shoved to the side. And it's still, a consumer-oriented economy, not an AI economy. So I think this is going to take some of the spotlight. But that being said, the reason why it has dominated just about every form of media, and by that I mean AI, it's because that's where the big money is being spent, and investors want to make money off of that money. So, we're stuck with AI for a while, but thank goodness we're going to get some other commentary on how the economy's doing.
Does it matter, though? I mean, we were talking with Eric Rosengren, and I was kind of asking about this idea, the fact that the consumer seems to be weak, and that's supposed to be 70% of GDP. He seemed a little sanguine about it, kind of like, look, I mean, as long as the business spending there, which is basically AI spending, is there, then, sometimes that's just how the cycles work.
Yeah, and I think that's right, especially for the stock market. The stock market doesn't necessarily really care about GDP all that much. It really doesn't. It's always looking for the next big idea and growth. Whenever anybody says, what do you do every day? I look for growth. I don't care if you're a value investor. You're looking for value companies that are going to grow. Wall Street rewards growth. So we have a big growth story here in the build out of AI, and that's why it's captured everybody's attention and all the money, because it's spending all the money, right?
Yep, absolutely. Kim,
growth.
Yeah, Kim, got to leave it there. Always love the conversation. Kim Forrest, founder, CIO over at Bokeh Capital Partners. And speaking of that growth story, we got it out of this earnings season. It's not over yet, but we're still tracking at about 30% growth in aggregate. A full breakdown of all of today's market action with our global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Isabel Lee, taking you through to that closing bell. It's a global simulcast. We're joined now by Carol Massar and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on a somewhat tepid end to the week, despite what obviously has been an incredibly volatile week when it comes to the equity markets.
Yeah, I feel like we're going out with a whimper, but you're absolutely right. Some big moves in, the overall indices as well as some individual names, but it does feel like we're just going into the weekend a little weak, if you will.
Yeah, that's fair. I kind of want to see what happens next week with retail earnings. We're going to hear from Walmart, Target, TJX. We got a read on the consumer today with retail sales that was underwhelming. But we'll hear from what these companies are seeing and maybe get a better idea.
It's Target, Tim. No one says Target
I apologize.
anymore. Yes, but it's been a good earnings season. I mean, I am looking forward to next week also. But for now, about 85% of the S&P 500 companies that I've reported have beaten profit expectations, and I believe that's the strongest in several years for now. Yeah, but that kind of creates the fear, right? The idea is like, have we sort of reached some sort of peak in growth? And I think that's what a lot of people are guarding for. We'll get a little bit of color, obviously, out of those big retailers, and we still get NVIDIA a week after that, and then that'll kind of close things out until, I guess, the next earnings season. Kind of interesting, though, on a day like today, we close out the week. The number one gainer in the S&P 500 is basically a company that does vehicle auctions, and the biggest decliner in the S&P 500 is Broadcom, a chip maker. You put it all together, and it is right across the screen for almost all of the major indices. Teaser here on the day. The S&P 500 down about 0.2% on the day, coming off of that record high. It's still up on the week by about 0.3%. The NASDAQ, similar story for the NASDAQ Composite and the NASDAQ 100, down on the day but up on the week. Dow Industrials down on the day and down on the week. And the Russell 2000, that is actually your bright spot. It is adding about 16 points here on this Friday afternoon, up 0.5 percentage point. And on a weekly basis, it's also your outperformer, up 1.1%.
It's because it knows you like that index. I'm just going to say. Hey, back to the S&P 500. I'm going to go there. 250 names is about higher in the index today. 244 to the downside, 9 unchanged. So almost an even split there.
And if you look at the IMAP, it's looking really even split and not a lot of huge gains there. Maybe the biggest gainer is energy, up by 0.8%, but the rest is flat. Like tech is down by tech is up by 0.03%. Financials.
Wow.
Yeah, but
did you know Tim Senovic hosted Bloomberg Tech today?
I did see that.
And I live to tell the tale.
That was great.
I live blogged the whole thing, Tim.
Oh,
hey, thank you for tuning in.
Yeah.
Your real-time feedback too was very nice.
I'm sure you appreciate it.
What was the feedback?
Oh, you said I was doing a great job. It was so nice.
Okay.
Well, until that one little glitch, but
then he sent another email.
I'm sure you were great, Tim.
Yeah.
I never get emails from you that I'm doing a good job.
You know what?
It's coming.
If you don't have anything nice to say, then don't say anything at all.
Yeah.
One day, Carol.
Maybe.
When are you going on vacation?
Keep striving.
In
Just
about 59 minutes.
All right, let's go to some of the individual gainers. I'm going to go on over to Reddit. At its high, up more than 16% today, finishing with a gain of 12.5%. Reddit jumping. It is set to join the S&P 500 prior to the opening of trading on August 18th. According to a news release, it's replacing Avalon Bay Communities, which is being acquired by Equity Residential. Stock, though, down more than 20% year to date. 14% of the float is short, and it's off more than 30% from a recent high back in January. But once those index funds start buying, that could be a bit of a boost there for that name. So we'll keep an eye on that. Certainly a boost in today's session. Hey, let's go on over to what is the top performing stock in the S&P 500 this year. And we often talk about it, SanDisk. The stock up at its highs about 9% today, finishing with a 7.4% gain. It's a top gainer in both the NDX and the SPX. JP Morgan initiating coverage. I thought this was kind of interesting. Assigning an overweight rating following the firm's investor day. The analyst there says SanDisk is in many respects uniquely positioned to capture the ongoing structural inflection in NAND demand driven by rapid growth in AI inference. So it was definitely an outperformer. Price target set at $2,250 a share, stock closing at $16.41 and change. So we're looking at maybe a 47% increase from the last close, excluding today's trade. And then let's go on over to Unusual Machines. Thank you, Tim, for that one. This one up about 24%. It's a drone parts company. It jumped also last night in the post-market and trading higher today in reaction to the U.S. government announcing tariffs on drone and related component imports. The Trump administration said it's applying a 100% tariff on imports of unmanned aircraft systems and their components. Now, keep in mind, this company is backed by Donald Trump Jr. Stock is up about 160% year to date. 23% of the float is short, but it definitely got some love on Wall Street in the Friday trade. And that's a look at gainers.
Okay, that's what got love on Wall Street. What didn't get love on Wall Street, that's my job, and that's where we start. Oracle, one of the worst performers in the S&P 500 today, actually fell by as much as 4.8%, but it closed down by 3.8%. This after a report came out that a new New Mexico natural gas pipeline project that would supply power gen systems for a planned Oracle data center has been delayed by nearly 6 months. We should note that Oracle out later telling Reuters that its data center project in New Mexico, dubbed Jupiter, remains on schedule and that it continues to work with its partners to move the project forward. Still, nonetheless, we did see shares of Oracle fall by 3.8% today. Also, a check of how Applied Materials did in today's session after reporting yesterday. Down 5%. It was lower throughout the entire day. This after the semiconductor capital equipment maker estimate topping forecasts met with tepid investor reaction. It follows that frenetic rally this year. Remember, shares were up more than 100% going into yesterday's print. Analysts were positive, though, in general about the company's results and forecasts. They're optimistic about the AI-driven demand boosting results. The big question, I think, is as a bellwether, what it means for the entire industry, not just for the remainder of this year, but over the next couple of years. You know, we don't really have an answer to that yet. And finally, QXO shares fell by 2.6% today. The company reported residential and non-residential roofing revenues that missed the average analyst estimate. Brad Jacobs, I know it's somebody that Carol and I have spoken to. Romaine, you've spoken to him in the past. Chairman and CEO of QXO. Nice. He said our second quarter results reflect current market conditions and the progress that we are making across the company.
All right, let's take a quick look at yields here because we did see a little bit of a movement today to the upside, and it kind of belies kind of what we've been seeing earlier in the week where, remember, we had 3 straight days, particularly with those 2-year yields falling slightly up higher by about 2 basis points. But really, it's going to be that 30-year yield, the longer end of the curve, that's shaping up to be the real story here in 2026. Those yields now at 5.2530, up 4 basis points from where they were yesterday.
All right, good stuff. And that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Isabel, of course, continuing on the close there on television. Tim and I back here on Bloomberg Business Week Daily. We will see you same time, same place on Monday. Guys, have a great weekend.
We've been talking about those big retail reports out next week, particularly on the back of that consumer sentiment number that we got this week. We're going to catch up with Katherine Black, managing partner over at Kearney, to get her take on where she sees the consumer going. That's coming up next here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romaine Bostick here, closing out the week with the S&P on the back foot, down about 0.2% on the day, though it does manage to notch a gain for the week, only of about 0.3%. But the momentum continues, and you actually see some broadening when it comes to this market. The Russell 2000, the bright spot on the day and on the week, gaining about 1.1% over the last 5 days. A mixed picture for gold and a mixed picture this week for yields, but keep an eye on that 30-year yield really unfolding to be the story of 2026. 2026. Of course, the story of 2026 in the equity markets remains SanDisk, the best performing stock of the year, and that's, well, pretty much the best performing stock of the day and of the week, up more than 30% this week on the back of that investor day, where it seemed to sort of reiterate this idea that this sort of growth story is not going to end anytime soon, providing forecasts all the way out through 2030 that seem to suggest the momentum will keep going. Can't say the same for Broadcom, really took it on the chin today. And then we want to talk about the retail space a little bit. Dillard's, the department store, disappointing in investors there, down about 9%. Meanwhile, you had names like Five Below, more of a discount retailer there, up about 1%, actually having a pretty good week on the back of some relatively bullish commentary by analysts. And that actually brings us to our top story, and it is whether the consumer is losing momentum. The University of Michigan sentiment survey released this morning seems to reinforce that idea, as did that weaker than expected report on retail sales released an hour and a half before that. Taken together, they do show an increased downside risk around consumer demand, but it does stop short of confirming any sort of sustained downturn. And I should be clear here, people are still shopping. That's undeniable. It's in the numbers. But the spending is increasingly selective, value conscious, retailer specific. So next week's batch of consumer company earnings could be an eye-opener. Those earnings are going to take us from the everyday value plays like Walmart to more discretionary names like Target, to bargain hunting icon TJX, housing sensitive names like Home Depot and Lowe's, to luxury over at Estee Lauder. Is there a tie that binds us all together? Maybe so, maybe not. In fact, the tagline for the consumer looks right now like it might be, quote, trading down, not shutting down. At least that's what Naveen Jaggi over at JLL's Retail Advisory Services business told us earlier this week.
Consumers are feeling energy pricing, housing pricing, rent pricing pressures are putting more pressure on their discretionary spend. So for right now, Walmarts and Costco's of the world are doing a great job of getting that customer, as is Target. But I think that aspirational retailer, they'll be feeling that pain in the back to school shopping. I think they'll get that consumer back during the holidays.
That was Naveen Jaggi earlier this week. Joining us now here in Studio 2 is Katherine Black, partner at global management consulting firm Kearney, where she leads the food, drug, and mass market retail coverage. Great to see you here.
Great to see you.
You saw the retail sales report. I don't want to make too much hay over one single monthly report, and I know there are a lot of asterisks to that contraction that we saw. But you track these trends, and trend being the key word here. What is that trend based on what you're tracking telling you?
Yeah, I think we're seeing a lot of the same that we have been seeing for a long time. And that's the headline message for me, is that it's a cumulative effect. So, yeah, I don't think it's a huge shock. I don't think we're falling off a cliff or anything. But consumers are still trading down. And we do see lower incomes consumers spending less and trading out of some things that are not discretionary. And we're seeing that at more pronounced rates than we were previously. And all of that's coming to bear.
I mean, we are basically kind of through the back to school shopping season. I mean, in some certain parts of the country, kids are already back in school. Was there any evidence here that suggested any sort of material change relative to the previous year, up or down?
Yeah, we just fielded our back to school spending survey, because consumers are still spending on back to school. Quite a few still have more shopping still to do. But we fielded it earlier this week, and we'll be releasing that next week. But what we're finding is that headline. Consumers are, as you would expect, shopping sales more often. That contributed to the retail sales number. They are trading down. They're trading down to different retailers, and they're using coupons, and they're clustering their clustering their purchasing to those bargains much more than they have been in the past, and they've been doing it for a while now.
Every time, or at least I should say over the last couple of quarters, every time we've talked to a retail CEO or CFO coming out of their earnings, they talked about this idea of a selective consumer, this idea that they're looking for value. And it didn't matter whether it was a high-end retailer or low-end retailer. That seemed to be a consistent narrative here. And it gets to this idea, we talk about the K-shaped economy. We had the Macy's CEO on who was actually talking about the E-shaped economy, which, I mean, we're getting a lot of prongs here. But it gets to this idea, is this a healthy consumer economy right now?
Well, I don't know if it's the most healthy we've seen, for sure. Consumers are still spending, but over 90% of consumers tell us that they're changing their behavior. And back to school, 90% said, I shopped differently this year than I did in previous years. And that was some combination of behavior. And that's, again, a continuation of themes that we've seen in past years. I think the healthiest segment that we're seeing, of course, is higher income, but also younger consumers. Younger consumers are really propping up the spending, and they're doing it in large most part with buy now, pay later and other mechanics.
Are they buying physical goods? Because I mean, I was looking at the retail sales report. I mean, the online shopping metric was down, but then you saw restaurant and bars was up. Does that tell us anything?
Yeah, I mean, look, I think they are buying physical goods, particularly back to school. They're shopping for kids, and that's one thing we see is people will shop for their kids. That's why we watch that metric so carefully and carefully for holidays. But they are getting back into restaurants. You know, restaurants has been interesting this year because there have been months where that's been a little bit depressed, and then months of real surges, oftentimes tied to big events. I think, you know, we're seeing still some increased volume from things like World Cup and summer weather and all that good stuff.
With regards to the earnings, and you know, you don't have to break down the individual earnings, but I mean, I think of a company like Walmart, which seems like whether times are good or bad, they seem to do well. Target's a little bit of a different story. People seem to lump them into the discretionary bag, although I feel like there's a lot of necessities, at least at my local Target, that I would think would keep them going there. Is this going to be one of these earnings seasons, not just now, but maybe even the next quarter, where we are going to see that K-shaped economy actually show up within the companies themselves, not just the consumer, but it becomes the K-shaped retailers themselves?
Perhaps. I mean, I think what you're seeing in a lot of retailers that operate on the more value end of the spectrum, they're seeing good earnings, but they're seeing a change in their mix. They're seeing more high-income consumers trading into their stores, and almost 30% of high-income consumers say they're changing the store that they're shopping at. It's one of the techniques that's being used. So we're definitely seeing that, and they're also benefiting from having, you know, the best value. So for people who are shopping and they're shopping non-discretionary, they're going to be going to value stores.
What about the luxury space? I mean, we get Estee Lauder, which is beauty products. Some would say that's a necessity. Others would say it's definitely discretionary. But we heard from kind of some of the European luxury makers, and that was a mixed bag. We heard from Tapestry earlier this week. They're still growing, just the growth rate's coming down a little bit. Do you anticipate any sort of hiccups in those companies that are more purely on the luxury side?
Well, look, I think a lot of that segment, particularly like the Tapestry and others, are still benefiting from the younger consumer. You know, 20 years ago, you'd think luxury is an older consumer. That's migrated down somewhat, and I think we're still seeing strength in spending in that group. I think one of the key things that I'm watching related to that group of consumers is that buy now, pay later. How are they doing with credit? If we start to see big risk increases, big defaults, or big shifts in policy now that buy now, pay later is reported on credit reports, that could really change shopping for that segment, and I think impact a lot of these players.
All right, Katherine, great to have you here. Katherine Black, partner over at Kearney. And remember, we get Walmart, Target, TJX, Ross, Home Depot, Lowe's next week. In the moment, though, we are getting those 13F filings. Berkshire's is out. Probably one of the more notable changes is that it actually adds D.R. Horton in the most recent quarter. Remember, this is basically the positioning at the end of June, and it also kind of has some significance, too, given Berkshire's recent purchase of another home builder in full, Taylor Morrison. We'll be back in a moment. This is The Close on Bloomberg. The mortgage loan company called Better. It was one of the more scintillating stories of the recent SPAC frenzy. In 2021, it agreed to go public in a blank check merger with Aurora Acquisition, in what would have been a $6 billion deal backed by investor SoftBank. But that listing, it was put on hold amid questions about the company's growth and now infamous round of layoffs for 900 workers that the CEO conducted on a mass Zoom call. By 2023, the company seemed to have course corrected, and it addressed its regulatory issues. It found its way to market on the morning of August 24th, 2023. By the close of markets that day, the listing had plunged more than 90%. The stock and the company have never quite recovered, and last week the board voted to replace founder Vishal Garg as CEO. Now, Garg isn't going away quietly. He says he's organized enough support from shareholders to retake control of the company and called for 5 directors to resign. In a statement late yesterday, Garg said, quote, "The company's current valuation fails to reflect the operational improvements already underway and that immediate action is necessary to restore shareholder confidence." Now, this morning, Better responded with its own statement, saying that the board is committing to acting in the best interest of all shareholders and will not be bullied into actions they do not believe serve those interests. It also says that the board's concerns extend beyond matters of corporate governance. Vishal Garg joins us right now, the founder of Better. Vishal, great to have you here.
Great to be here. Thanks so much.
A lot going on here. You left on August 3rd. There was a statement out that said the decision was mutual.
Sure.
Now you want back in. Was it not mutual?
The decision was abrupt, and I was given a set of choices, and I thought, let's do what's best for the company. Since that time, the stock price of the business has gone down by 45%. I thought maybe someone new might be able to help. The markets, shareholders are all surprised by the new CEO's actions. And
the new CEO, you're talking about Daniel Lewis, the interim CEO.
That's correct.
But I mean, August 3rd was, 10 days ago, 11
That's
days
correct.
ago. What's happened in 11 days?
I think we've seen a number of actions by Daniel that haven't reflected well on the company. I think we've had the stock market vote on this. I think we have a number of deals that we were executing where I think we were in the middle of it. And I think just fundamentally, the job of making homeownership better for all Americans is not done. We had made a lot of progress over the past 2.5 years. We'd grown revenue from 70 million to over 200 million. We had cut losses. We were at the 5-yard line of getting to profitability. And I think all of those things are better done and executed with someone that is not the board's current choice.
Do you have any examples, though, specific examples of anything Daniel Lewis did that gave you concern?
I think the board firing the 12-year founder and CEO in the middle of the day on a Monday, having a new CEO come in, and that new CEO departing for the south of France on vacation for the rest of the month 4 days later is not an indication of confidence for the company, its employees, or any of its business partners.
I do have to ask you, though, in the statement that Better released today, and we didn't put it on the board because it was kind of sensitive, but I'm going to read it to you verbatim. And I'm sure you saw it. It says, the board has reviewed communications that, based on counsel's analysis, is evidence of Mr. Garg's direct involvement in conduct the counsel believes may constitute violations of U.S. securities laws. What are they referring to?
I think that's total bupkis. I think that those are just, first of all, they didn't refer to anything specific.
They did not, no.
I think they've couched it because based on counsel's analysis and so on and so forth, could. So I think fundamentally, I think that those allegations are bupkis. I think they're meant to deflect from the fact that Daniel Lewis doesn't have the support of the employees or the shareholders of the company.
Do you have the support of shareholders? I mean, how many votes have you managed to sort of corral on a percentage basis?
We have already corralled 52% of the vote.
You have 52%.
That is correct. The shareholders have spoken.
And which share class do they hold?
They own both Class A and Class Bs.
Are these declarations binding or revocable, or is this just a handshake agreement?
No, they're all binding. They've been delivered by counsel to the company.
Okay, so then give me a sense of what comes next. Are you preparing for a fight?
I don't think there needs to be any fight. I think there's going to be a consensual resolution. And if there's not a consensual resolution because of the company's bylaws, the vote of the majority class is binding upon the company. So I think the company will either need to accept it today, Monday, in 10 days, or at the absolute latest, depending on the process, in 35 days.
So according to you have the shareholders' support. Do you have the money?
We don't need any money.
You don't need any money?
No.
At all?
No. The company is well capitalized. The company has been growing despite the Iran war. We grew revenues 15%. While people were dropping drones and bombs.
I just want to be clear here. But I mean, it said you would invest $5 million personally through a 10b5-1 plan.
That's correct.
It also said that there was, quote, another $30 million alongside shareholders. Where's that $30 million
No,
coming
the
from?
company is going to buy back up to $30 million.
To buy back?
Yeah, buy back up to $30 million.
If you were able to get back control.
That's
correct. The idea.
Yeah. So the company is going to invest in its own shares because the company's shares are fundamentally undervalued relative to where they were just 2 weeks ago. This time 2 weeks ago on Monday, the stock price was something like $27 a share. Yeah. And today it's nearly half that.
But why buy back stock? This is a company, I mean, just purely based on the fundamentals that have been reported, it's still burning cash.
The company's burning cash. It's on its way to profitability. The company is in the process, and this is public, of selling its bank in the United Kingdom. And if we are able to generate both proceeds from operations turning profitable over the coming months and execute the sale of the bank, which will release over $70 million in cash to the company, then buying back the company's stock is one of the best things it can do for a stock price that is at the same level today as it was 2 years ago when the revenues of the business were $70 million. And today we're the leading AI platform in the mortgage industry, a $15 trillion asset class.
Yeah.
And, we've got over $200 million of revenue, and the stock trades, at 1.5 times revenue.
So the UK deal, that's more or less a done deal? Is that what you're telling us?
I'm telling you that we are very, very close.
You're very, very close, but nothing binding with regards to that sale?
No, nothing binding so far.
I am curious about the board. Do you have a sense of who you would want as directors? Have you lined those people up, or is that a decision that you're going to make at some other time? If this moves forward?
We have communicated to the company who we'd like on the board.
Are the ways that the bylaws are written going to give you the power, even if you were to get the shareholder support on this, to actually be able to appoint those directors?
It will.
And you're confident of that?
I'm 100% confident.
Have you been in direct communication with the company over the last few days about this?
Yes, we were at a board meeting just earlier today.
Okay. And what did they tell you?
They have to consider the proposal that we sent.
All right. Vishal, a lot going on here, and we need to get you back to talk about it and see the progress. We appreciate you coming on.
Thank you so
and being
much.
Candid.
Yeah, thank you.
Vishal Garg, he's the founder over at Better.com, the former CEO, now trying to take back the helm of that company. When we come back, we're going to switch to cars, and it's a big car, a powerful car. Aston Martin revealing its latest supercar exclusively right here on Bloomberg. All right, let's go out to Carmel, California, because luxury sports car manufacturer Aston Martin revving up its newest vehicle, the Aston Martin Vallon from its V12 series. The company touting it as the most powerful front-engine Aston Martin in its 113-year history, and it's limiting production, well, to just 150 cars worldwide. Joining us right now is the Chief Executive Officer of Aston Martin, Adrian Hallmark. Adrian, great to have you here. I am curious. Just talk to me about the specs real quick. When we talk about the most powerful, I remember the Vanquish. What was that? Something like 135 horsepower. What are we talking about here for the new Vallon?
Okay, so thanks for having us on the show. And the Vallon is more powerful than a Vanquish. It's 850 PS and 1,000 Newton meters of torque. And I forget what those numbers are in imperial measurements, but a lot more than any car that we've done before. So it's the fastest 12-cylinder front-engine car from us, but also from any other car company. It's the world's fastest.
Well, so give me a sense here, though. Why did you feel the need to go from whatever that 835 PS up to the 150 plus PS? It's notable, but did you need to do that?
It's that segment of the marketplace. So the car is not all about the engine. The engine is absolutely the heart of the vehicle. But if you take the whole concept of the car, it uses our components from our aluminium space frame technology, and then a full carbon fiber body. It's way lighter than any of our 12-cylinder cars that we've ever built, apart from the Valkyrie hypercar, of course. And combined with this engine, a GT motorsport gearbox, a different rear axle ratio, the whole driving experience is completely different to any road car that we offer. So it really is a specialist car at the top of our range for collectors and connoisseurs. That's the whole point of the car.
Well, let's talk about those collectors and connoisseurs. Only 150 of this, so that by default makes it a collector's item, roughly $2 million each. So definitely you have to be not only a connoisseur, but also have deep pockets here. What is the goal of releasing a product like this overall for your business model with Aston Martin as its relatively new CEO?
It's absolutely essential for our future success. We have a core range of cars that we're very proud of. We go from an SUV to a mid-engine hypercar to 3 amazing front-engine GTs. But we're one of the few brands in the world that can and have successfully in the past offer cars in the $1 to $3 million range at significant volumes, and the contribution we get from those cars is a real boost to the overall performance of the business. So we now have about 1,000 customers worldwide that spend more than $1 million with us every year. And for those customers, we like to create every 2 years or so something extraordinary, very collectible, very special, and at the leading edge of design, technology and our capabilities, and this is one such example.
You know, it's funny. I thought V12s were dying out here. I mean, yeah, regulation, electrification, you know, all the sort of pushback there. And I know that this is obviously a somewhat niche product here, but I am curious as to whether this maybe is sort of a testament of the V12 maybe outliving all of those concerns and all of those forecasts about where it seemed like we were going a couple of years ago.
You're right. I mean, the change in policies in many countries around the world in the last 24, 36 months has been pretty dramatic. We're now in a situation where all of our future planning indicates that we can continue to sell the 12-cylinder versions of our cars through to 2035 in most countries and in most regions. We will, of course, make them compliant with the next level of emission standards that appear in 27, 28 calendar years. But we have a clear roadmap for the next 9 years to still be able to offer 12-cylinder engines. And the reason we do it with this car is very clearly that for the real collectors and the car enthusiasts, of which this is the biggest collection in the world at Quail and Pebble Beach, they just love this kind of powertrain. It may be close to the end of this era of automotive history, and they want to make the most of it, and we help them to do so.
You're coming up on your 2-year anniversary as head of Aston Martin Lagonda. I am curious about the sense of how much sort of the path back to profitability for this company runs through cars like the New Veyland versus, say, you know, the core that we all tend to think about with regards to the DB12, et cetera, and Vantage.
Yeah. I think, first of all, we need to be more profitable with our core products. So you probably recognize that over the past year and a half or so, we've made major strides to basically bring down the cost structure of the company so that we can be profitable and cash generative at a much lower volume than we previously planned. This isn't a retreat from growth. It's a different way of getting there. It's to create a solid foundation of a business with the core models so that the Valhalla, of which this year we'll probably sell 500 cars at $1.4, $1.5 million, these cars then really give us a turbocharge, if you pardon the pun, to the financial performance of the company. So in the second half of this year, and certainly into next year, we should be in a position where we can demonstrate we've turned the corner, we can generate positive cash rather than burning cash, we can generate positive EBIT instead of negative EBIT, and we're on that path with a volume per year of about 6,000 sales with a credible mix of these specials at the top end. And that's the basis for the new business model, at least for the next 3 years, 4 years, as we transition to the next generation of cars.
Yes, we've definitely seen the revenue up, the volume up. Obviously, the loss is still there. But as you sort of work your way back to cash positive, I am curious about how you view the valuation of the stock, particularly given one of your main competitors in this luxury space, Ferrari, trades at a luxury multiple, certainly compared to where Aston has been trading, which is, let's just be blunt, kind of like a distressed car maker.
Yeah. And there's no question that the performance of the shares has been pretty dramatic over the past, well, 4 or 5 years, actually. I think as soon as we demonstrate that we can deliver consistently from a financial point of view, the fundamentals are there. We have restructured the cost structure. We have got the product portfolio that can generate credible contributions. And with that cost structure and those contributions, we have a clear business plan and a roadmap to get to profitability and a much stronger business model. That's been the work of most of my last 2 years, to get us a clearer strategy, a winning strategy that's not driven by achieving super high volumes, but instead getting a much more value-based growth strategy rather than volume-based. And that's been the change over the past 18, 24 months.
Talk to me, though, about the people you need to do that, because as you were sort of trying to get costs under control, you did cut several hundred jobs, and then you're launching these ambitious products, a product that is, you know, if not bespoke, certainly very close to it, and that requires a lot of human beings. I mean, it can't all be automated, it can't all be done by machines. There's obviously a lot of thought, a lot of design, et cetera, that goes into that. So how do you maintain the craft and quality of a $2 million car, say, or even the more pedestrian, you know, $300,000 or $400,000 car, while cutting back such a huge amount of your workforce?
Yeah. It's the same conundrum that most businesses face in our situation. But the good news is, actually, as you improve quality, you need less people. I'll give you a simple example, and we've used these numbers regularly in the past. When I first joined a couple of years ago, about 25% of the cars that we built came off the production line and then had to be reworked post-reduction. We've got that figure down to about 1%, which means instead of spending extra hours at the end of production, the cars run straight through. They also then run straight through to dealers, and there's virtually no activity required in the dealer network. So in many aspects of the business process, improving quality is a key to releasing workforce and people. It's not the only thing. Of course, losing people in any organization is not a strategy. It's not something that we want to do. But we had to become more efficient. We had to bring the cost structure down to meet the revenue and contribution profile that we could predict and rely upon over the next 2, 3, 4 years. And that's what we've done. Not at the expense of quality. In fact, quite the opposite. So that hasn't hampered us at all. Quite the reverse.
Do you think you're going to need to raise more capital, go back to capital markets?
No, I think the last financing that we did a few weeks ago has now given us more flexibility than we had before, sufficient flexibility to allow us to deliver on this new business plan and deliver both the current products and all of the innovations that we have in derivatives, these tactical products like the S versions, but also get us ready to deliver the next generation of cars with brand new technologies, compliant engines for the next level of emission standards, etc., etc. And of course, the newest level of electronic architectures, connectivity, autonomous capability where necessary. So now we're well now set up to deliver on the strategic plan that we agreed with the shareholders, and we're all systems go.
All right, Adrian, I'll let you get back to it. Obviously, very busy behind you, and I would love to hear how that car sounds one day. Adrian, Hallmark, the CEO of Aston Martin, unveiling the most powerful front-engine supercar out there at the Quail at the Peninsula in Carmel, California. Meanwhile, we are keeping an eye on those 13 F filings where we get a sense here of what people actually hold. And we're getting an interesting headline right now coming out of Harvard saying that they actually are disclosing a stake in SpaceX. Roughly about the headline, according to this, is $2.2 billion, a stake in SpaceX. That is the holding now by Harvard, not really having much impact on SpaceX's shares. But again, we are keeping an eye on some of these disclosures that are crossing the wire fast and furious here in the After Hours Trade. This is Bloomberg. We're just about 3 weeks away from the start of the National Football League season here in the U.S. And if you want to watch it, well, you're going to have to pay up, particularly to see all your favorite teams play on Sundays. The explosion of streaming services out there is actually now forcing fans into paying for multiple subscriptions. Remember, back in the old days, you could just watch it for free on the networks, but that era is over. And the rising costs have actually caught the attention of federal regulators, with the DOJ here in the U.S. now investigating whether the NFL violated antitrust laws. They're also investigating other sports leagues as well. Joining us right now to talk a little bit more about what exactly is going on is Kellie Lerner. She's a managing partner at the antitrust law firm Shinder, Cantor, and Lerner. She specializes in antitrust litigation. Kellie, I'm fascinated. We wrote a great Bloomberg story on this, and anybody who's a sports fan know, I mean, you're paying hundreds of dollars, in some cases thousands of dollars, to watch all of your different sports across all of these different leagues. But there seems to be some concerns about exactly what type of deals the NFL and others struck with the streaming services. And let's start with NFL, because Sunday Ticket is kind of like the granddaddy of them all here. And they have that partnership with YouTube. What are we talking about here? What's going on?
Sure. So the background for Sunday Ticket really begins with a 2015 lawsuit against the NFL for bundling every game into one package. And the issue there was that it stems from a 1961 antitrust exemption for pooling your rights for broadcasts. And so what would happen in a perfect market is that the NFL teams would each compete with each other to market their broadcast rights. But instead, there was this exemption from 1961 that said that teams could pool their rights together for sponsored free over-the-air broadcasts. And in 2015, there was the very first challenge to that very old law that predates current streaming that said, hey, you can't collectively do this. You have to compete. And if I'm a sports fan and I live in New York, hypothetically, and I have 3 sons who are diehard Philadelphia Eagles fans, I should be able to just get Eagles games. But instead, I have to buy a package of every single game, much of which I have no interest in watching. So that's the genesis of where we are today. The plaintiffs in that case actually won in a jury verdict, which was then overturned by the judge and is now up an appeal to the Ninth Circuit. And in the meantime, the leagues are pooling their rights and spreading out their content across a multitude of distributors between streaming and cable and broadcast.
Right.
So just as you said, it's extremely expensive to watch your favorite teams, and it's extremely confusing to figure out where you can even catch those games.
It's absolutely confusing, and anyone who's tried to watch the NBA knows that, and the NFL to a certain extent. But I am curious, just legally though. I mean, you talk about all these disparate sort of streaming services and everything sort of spread out. I mean, when I think antitrust violations, I think the exact opposite, that things get concentrated into sort of one little pocket here. I mean, what would actually be the relief here? If it's not going to be dispersed amongst all these platforms, then what's the relief? Just not charging? I don't understand.
So it's actually the opposite of not charging. It's that there would be a free market where each team could individually negotiate where its games will be telecast so that okay, if I want to watch the Eagles, I need one subscription. I need whoever they decide to distribute with. Say it's Amazon. Okay, if I want to watch the Eagles games, I just have to get an Amazon subscription. Instead, they're pooling it with all of the teams, which means that you have to get up to 4 or 5 different subscriptions or cable services just to watch your favorite team.
But isn't this the NFL's argument? And this has not only come up with regards to the streaming stuff, but it's come up before in other antitrust issues that have raised. They've kind of made the point that the NFL is a joint venture and that you have to have the 32 teams coordinate to some degree or another to produce what the NFL is trying to produce. Is that not a valid argument?
Not according to the Supreme Court. There was a decision, the American Needle decision, about 15 years ago, and it said that these are individual economic entities. So there are, and this is really, I should be clear, the SBA, the Sports Broadcasting Act of 1961, just addressed an immunity. Are they immune from the antitrust laws? One could absolutely argue that in this environment with streaming and cable, this act was never meant to apply an immunity in this context. And so as individual entities, they should be competing with one another for the benefit of each individual team and ultimately to the sports fans.
Well, House Republican investigators, they actually said that the NFL rejected an ESPN proposal for, I think, roughly about a $70 Sunday ticket as opposed to this team-by-team product, which is what kind of gets some of those overall costs for consumers a lot higher. If that is accurate, and I'm not sure it is, but that's what they're claiming. If that is accurate, does that provide evidence that the league is in some way trying to protect the price of its bundle rather than allowing for that freer market, if you will?
Yeah, the hallmark of market power is the ability to charge what antitrust lawyers call monopoly rents, but we'll just say overcharges. And so the reality is that if you broke up that concentration of power, there would ultimately be less money flowing to the NFL league overall because each team would be negotiating on its own merit. So right now, they're benefiting from that concentrated market power by ultimately being able to extract more money from the system. And in a perfect competitive world, the teams would compete with each other. What does competition do? It lowers prices. That would be to the benefit of consumers and fans across the country.
I know we're picking on the NFL, obviously, because that was primarily the main case here. But when you look at the other sports leagues here, at least here in the United States, Kellie, is this kind of the same story, more or less?
Yeah, the exemption applies to all 4 major sports leagues. So basketball, football, baseball, and hockey. They're all benefiting from it. The NFL makes the most money across the board, $14 billion. So they tend to get most of the attention, but the other leagues aren't that far behind.
All right. You know, this is fascinating. I don't know how this works out legally, but certainly as a fan, I could tell you it'd be nice to just have a little more clarity. I mean, forget price for that thing. I do have to ask you, though, you're an Eagles fan?
I'm married into an Eagles fan.
Okay, all right. Because I was looking at your background. I was going to say, all right. Well, anyway, hopefully you can get your games, and hopefully you don't have to pay too much for them. Kellie, this is fascinating stuff, and appreciate you kind of explaining it for us lay people out here who don't necessarily understand all the legal nuances. Kellie Lerner there, a managing partner over at Shinder, Cantor, and Lerner. All right, when we come back, we're going to set you up for what to watch over the next week. We've been talking a lot about it, but there are some big earnings to keep an eye on, and we'll break that down for you when we come back after the break. This is Bloomberg. Let's set you up for what to watch next week. We start off on Monday with earnings out of BHP, some housing index numbers, and a slew of data, economic data coming out of China. And just a programming note, the close will be partially on the road next week out at Martha's Vineyard in Massachusetts. Some sit-downs here with Advent International partner Kahina Van Dyke, as well as former Walgreens CEO Roz Brewer. On Tuesday, that is when these retail earnings start to come fast and furious. Home Depot is out before the bell that day. We're also going to get housing starts and pending home sales numbers, so it'll be an interesting overlay here to see what those numbers look like for Home Depot and what those government numbers look like as well. The following day, another read on the consumer. Lowe's will report, but so too will Target, TJX, as well as Estee Lauder. So a nice cross-section of a lot of different areas of the retail landscape. We're also going to hear from Analog Devices that day, and we're going to get the Fed minutes from that last meeting. And of course, everyone is much more laser focused in on those minutes, given some of the changes made by Kevin Warsh. On Thursday, we get earnings from Deere, Walmart, Alibaba, Ross Stores. And then on Friday, we're going to round out the week with some more economic data. And this time, it's a closer look at some of those PMIs. The S&P Global Manufacturing and the services PMIs are out that day. So your setup for next week is largely going to be a big read on the health of the U.S. economy. And of course, we will have full coverage of the health of the U.S. economy like no other right here on The Close next week. We hope you join us then. For all your political coverage, stick around. Joe Matthews up next at the top of the hour with Balance of Power right here on Bloomberg.